talking about Chapter 10. So if you would follow along with your printout of your handout and the PowerPoint, you can fill it out and kind of cover what we've gone over, what we will go over in class, or if not, we'll do some extra homework assignments instead of going over this. Okay, so some things we're going to talk about in Chapter 10 is basically property, plant, and equipment, but basically how do we buy it, which are these two items. After we buy it, what do we do, and then how do we get rid of it. So if you'll notice that basically you buy an asset, you use it, you get rid of it, and that's how this chapter is set up. So some property, plant, and equipment. So what makes something property, plant, and equipment is this item over here. It's basically used in operations and not for resale. So some of these items you probably want to put examples of what they're not. So fixed assets are used, they're not for resale. In other words, it's not inventory. It's usually long-term in nature. Also, let's go back to this one. It's also not an investment. So for instance, you can have land is usually a fixed asset, but if you buy land for an investment, it's not a fixed asset. It would go under your investing section. It's long-term in nature and usually depreciated, so it's not supplies, and it possesses a physical substance, meaning it's not an intangible. Some intangible assets are goodwill, patents, copyrights, that we have a court system in place to protect their rights. But property, plant, and equipment are, have a physical substance. You can touch it. Okay. Next one, what is most often used as a basis to record assets and why? We generally use historical cost. One reason we use historical cost is because it's very reliable. If we had all of our assets appraised every year, one, it would be very expensive to get all of this done. So just look around where you're sitting now and assume that you had to have somebody appraise each and every single asset. It's also objective, so if you can pull out an invoice and show what you paid for it. So historical cost is what we currently use. We don't revalue assets to fair market value. One, it's pretty expensive to get, and two, it's really not that objective like marketable securities we could revalue quite objectively. Okay, so the next one, what cost do you include in the purchase price? I'm going to kind of go through the following slides, and you're going to see that the rule of thumb can be kind of, didn't leave much space, but it's basically every cost to get the asset ready for its intended use is added to the cost of the asset. So what does that include? Purchase price is generally what we include, but notice any closing costs. So if you pay attorney fees or recording costs, that's added to the cost of the land. Notice that it's ready for our intended use. So if I buy a land with a building on it, and my intention is to bulldoze the building down so I can build a new building on it, the cost of the land includes the cost of the building as well as the clearing fees, because my intended use is to put a new building on it. So until I start digging the foundation for the new building, everything would be included in the cost of the land. So closing costs, cost of grading, filling, draining, clearing, because I'm getting ready to put a new building on it. Assumptions of any lien, mortgages, or encumbrances on the property. So for instance, if I buy a building from somebody else and I pay off their existing loan, so if I bought a building and I'm going to assume the mortgage, so let's say they still owed $60,000 on it, and I paid them $40,000 in cash, and I'm going to pay their $60,000 mortgage off. In essence, I have paid $100,000 for that. So that's where the assumption of mortgages or encumbrances on the property. Any additional land improvements that have an indefinite life, that's kind of gets the clearing, draining, etc. might have an indefinite life. So I'm going to go through the other slides and notice land improvements with limited life, so I have those as land improvements because I will depreciate it. So anything that's going to be depreciated, land is not depreciated. Anything that's going to be depreciated, I will put in land improvements. So sidewalks, parking lots, etc. Notice this kind of gets back to what we put over here. If I buy land for an investment, it's an investment. If I'm a real estate, land is my inventory, land would be my inventory. So that kind of gets back to these items. Buildings, any cost to get the building ready for its intended use is added to the cost of the building. So if I'm building it, material, labor, overhead costs, even an interest during the construction phase is added. Any professional fees, etc. Cost of equipment, if you read through those, you'll see that basically until I turn the equipment on for the first time, the costs are added. So just kind of read through that. Okay, so notice these are answers to these. So I really want you to think about it. Money borrowed to pay a building contractor would be, you might think it's added to the cost of the building, but if you think about your journal entry, I debit cash and credit notes payable, so it's not added to the cost of the building until I actually pay the contractor. But payment for construction on notes proceeds is building, cost of land filling and clearing is land, delinquent real estate taxes on property assumed is land. Sometimes I actually buy property for the delinquent taxes because the city will, in essence, repossess, except they take the property because the real estate taxes haven't been paid. And so basically, somebody can sometimes buy it if they promise the city that they will maintain it, improve it, etc., for the delinquent real estate taxes. So sometimes that is the purchase price. Notice that during construction, I haven't yet opened the building yet, so it's cost of the building. But if I refund that premium, I sometimes take refunds against the asset it was taken against. Architect's fees, I'm kind of going to go through these. I want you to read them. Notice the cost of raising, which means bulldozing, and removing a building is adding to the cost of the land because the intended use of the land is to get it ready for a building. But if I get some proceeds from the salvage, so if I demolish a building and had a lot of copper in it and I sold the copper, I would take that against the land. So notice again, just like I did in this previous one, where I had a refund of an insurance premium, if I get proceeds from the salvage, I take it, it's a negative land. So in other words, if this cost me $100,000, but I got $20,000 back from the salvage of it, my land would go up by $80,000, the net of it. Okay, you can kind of read through those. All right, next one, what do you overhead for self-constructed assets? Self-constructed assets kind of provide some issues because the cost of getting the asset ready for its intended use is added to the cost of the asset. So we're going to talk about some of those. So cost includes materials and direct labor, and you would have guessed that. But overhead can be handled in two ways. So for instance, let's say you have a truck that you drive around to several construction sites, or you have all your equipment and tools that you use on several construction sites. What do you do with those if you're building it yourself? So you can assign overhead just like we did in management accounting, and notice we assign overhead. So you might assign your overhead on the basis of direct labor hours. So if you recall, you take estimated overhead divided by your estimated base, which might be direct labor hours. And then if a building takes 100 labor hours, you would multiply 100 times that allocation base. What does GAAP require you to do with interest costs incurred during financing? I think I should have put building. Okay, so I need to change that to construction. So what happens of interest costs? Interest costs, you haven't opened the building yet, so interest costs are capitalized during the process of construction. And the process is kind of complex, so we're going to go through that. So it requires the capitalization of interest. So again, all costs incurred to get the asset ready for its intended use are added to the cost of the asset. So basically, we add interest during construction to the cost of the asset. So capitalization incurs what is a qualifying asset? And we're going to talk about that. What is the capitalization period? So in other words, during the construction period. So when does the construction period begin and end? And how much to capitalize? And that's what we're going to go through here. So a qualifying asset, those that you would capitalize interest on, are assets under construction for this company's own use, and assets intended for sale or lease that are constructed or produced as discrete projects. So in other words, if I build my own building, if Quincy University Maintenance builds its own building, that would be for its own use. If we had a construction company that was building something to sell for another person, the interest that the construction company incurred would be added to the cost. So if you think about sales minus cost of goods sold would include the interest costs that are capitalized. Okay, how much do you capitalize? This is the complicated part of it. You capitalize the lesser of. So someplace, make sure you know that. It's the lesser of the actual interest costs or the avoidable interest. So the avoidable interest is the amount of interest costs during the period that the company could theoretically avoid if it had not made the expenditures for the asset. And we'll talk about that in just a little bit. Okay, so this is the same one that you have on your handout. Actually, it's not the one you have on your handout. There's two of them in this PowerPoint. We're going to go through the next one. So assume the company borrowed $200,000 at 12% interest from State Bank on January 1st, 2017 for specific purposes of construction of equipment to be used in its operations. So we're building it for ourselves. So construction began on January 1st and were completed on December 31st. So in other words, the construction period is exactly a year, which is important. So what they did is they actually paid on January 1st $100,000. So sometimes you have to pay a down payment on it. So, or you have to buy materials to get started. It's hard to build a building without actual materials. So we paid $100,000 on it, and then on April 30th, we paid another $150,000. So we might have bought more materials as we're progressing, etc. So these are the date of our expenditures. So notice we borrowed $200,000, which does not cover the $650,000 whatsoever. But what happened is we had other bonds outstanding that we could use the cash from to build the building. So notice we have 200 plus 500 plus 300. That alone is 800,000. So this is $1 million we had available for us. But notice we had this debt outstanding, so we may have used some of the proceeds of the bonds payable for other purposes and some of this note for other purposes. These were just already outstanding. Okay, so remember, we borrowed $200,000 specifically for this, and we drew upon some other debt. Okay, so determine which assets qualify for the capitalization of interest. So it qualifies because it requires a period of time. So in other words, we have to build it and it'll be used for us. The capitalization period is the time that we're constructing it until we use it. So January 1st, so a year. And so we would capitalize the interest costs during the year. So the first thing that we need to do is notice that we didn't spend the $650,000 all at once. So we didn't borrow money, $650,000 all at once. Okay, so we shouldn't calculate interest for the entire year. So we have, what we do is we do the weighted average of accumulated expenditures. So this $100,000 was outstanding from January 1st to December 31st, so $100,000. This one was April 30th to December 31st, so so May through December, in other words, so 8 months, November through December, so 2 months, and December 31st was the last day of construction, so it's 0. So our weighted average accumulated expenditures are $250,000. Select the appropriate interest rate. So basically, remember, we borrowed $200,000 for the construction project itself, and then we had 2 other items of debt. We had 14% bonds and 10% bonds, okay? So first of all, we're going to use the debt that we actually used. So notice we had specific debt of $200,000 and it had a 12% interest rate. But remember, our accumulated expenditures were only weighted average were $250,000. So we have $200,000 that's 12%, and then we had these 2 that have 2 different debts, so we just average those. So we'd use a weighted average. So the interest on the $500,000 debt was 14%, so that's $70,000, and $300,000 is $30,000 of interest. So we had paid $124,000 of interest on $1 million of debt. We averaged that out, and we paid $100,000 of interest on $800,000 of debt. This just the general debt, because this one is specific to the item itself. So the average interest rate of these 2 is 12.5. Don't just say it's 12%, because we had more of this. We had more of the 14% debt than the 10% debt. So the average is 12.5. So, excuse me. So our accumulated expenditures, remember, if I back up a couple slides, this was only $250,000. So first I'm going to use the debt specifically for that project, which is the $200,000. It's at 12%, and then anything excess is at this weighted average 12.5%. So we have $6,250. So we have $30,250 of interest. That's our avoidable interest. So our actual interest is the interest we actually paid. Our avoidable interest is the interest on the weighted average. So I'm trying to think of a time when this would be less than this, but it's not coming to me. So I'm going to capitalize the lesser of the avoidable interest or the actual interest. So I add the avoidable interest to the project. So notice I debit equipment and take it out of interest expense, because when I paid it, I debited interest expense and credit cash. So could I credit cash? Well, sure, if I'm paying the interest and I know to add it to the equipment. But in general cases, when I pay interest, I debit interest expense, credit interest payable. I shouldn't have put it in interest expense. I should have put it in the equipment. Okay, so now the one on your handout. So notice that I paid the contractor to construct a building for 1.4 on land that cost 100. So I have a total of 1.5 million. Notice I'm not going to construct land. So this is important that you know it's 1.4 million for the building and 100,000 on the land. So one question we have to ask ourselves, what do we do with land if it's included in the purchase price? So notice I didn't pay it all at once. So I did my construction during 2017, so for an entire year. So let's go through that. So then I also had the following debt. I borrowed $750,000 specifically to build it. Let's go back. I had $1.5 million and I borrowed $750,000 specifically to build it. I had other debt outstanding on other loans of 10% and 12%. So again, I have way more borrowed than my construction expenditures. So the first thing I need to do is capitalize my interest. So I have January 1st, so my expenditures are January through December. I think I'm going to get those in there. Let me pause it. Okay, so let's see if I can get it to go. All right, so this one is outstanding for all the years, so it's 12/12. So this one was outstanding for March 1st, so everything but January and February. So it was outstanding 10 of the 12 months, so I take it times 10/12. May 1st, so everything but January, February, March, and April, so it's 8 months. and this one was December 31st, so it's the last day of the year, so that should be 0. Okay, so our weighted average expenditures is $820,000. So now I need to figure out the interest on that $820,000. So notice that adds up to $820,000. That's pretty important. And also notice that if I go back on my slides, I borrowed $750,000 specifically for this project. So I'm going to always use that first, and then I'm going to use the average of the interest rate on these two. So this one first, and then whatever the average is, which is not 11%. It'll be around 11%, but I borrowed more at 12%. So it's weighted average. It's going to be a little bit closer to 12%, so slightly over 11%. Okay, so first of all, the interest rate on the specific debt was 15%, so I have avoidable interest of $112,500, and then I need to average these two. So notice I had $550,000 at 10%, so that's $55,000, and $600,000 at 12%, so that's $72,000. So the average interest is $127 divided by the principal, so my average interest rate is 11.04%. So I take my remaining $70,000. That adds up to the weighted average construction expenditures. If I go back a slide, that was my weighted average outstanding debt. All right, so my avoidable interest is $120,228. I compare that to my actual interest that I paid. It's $239,500, and so I need to capitalize the lesser of the two. The lesser of the two is $120,228. So again, most of these problems have you constructing it for a full year. It could be, in circumstances where the times were different, that you would have more actual interest you paid, but in most cases, you're going to find out the avoidable interest is actually less than the actual interest you paid because we have other debt outstanding. All right, so here's my journal entries that I'll have. So make sure that you have your numbers in front of you. So if I go back on your handout, if you go back out on your handout, I've made a payment of $210, then $300, then $540, then $450. Okay, so this is what I need to do. So on the first one, notice it's $210. So the credits to cash are these payments. So I take $100,000 to land, and I take the rest of it to buildings, or generally a lot of times they take it to construction in progress, which is just a holding account, and when they get done with it, they take it out of construction in progress and take it to buildings, or allocate it to the various assets they're building. So the rest of it goes to construction in progress. The next one, $300,000, all goes to buildings, all goes to buildings, all goes to buildings. And then I need to add my capitalized interest. My capitalized interest is on the previous slide of the amount of interest that was the lower of the two, but here's what I actually paid. So when I actually write the check for the interest to $239, $120,228 goes into the buildings or the construction in progress, and the $119,272 goes into interest expense. Last thing that I wanted to point out, I talked about it before, then I forgot about it, was what happens when, notice it's $1.4 million for the building and land is $100 million. When you have land included in the purchase price, all of the interest capitalization that you paid goes to the building because obviously I don't construct land. So I don't have to really subtract out the $100,000 on it. I simply, remember I'm computing my weighted average accumulated expenditures. I don't separate out the land cost, but when I compute my interest, it all goes to the building because I cannot construct land. There are times when you may say you construct land if you improve the land, etc., but you would have to actually, in essence, build the land to have it added to the cost of the land. Okay, so these are, we've answered some of the items on this sheet. So the compute the actual interest cost, this is where you would have 239,500, and then I'm going to capitalize the lesser of 120,228 or 239,500, and these are these entries. You probably have to squeeze them in there in two separate columns, but again, notice that they're the actual payments for cash. Do a couple other ones, and then I'll interest costs during construction. We have to disclose it someplace in the financial statements how much interest is capitalized. I want to also add that you don't capitalize interest on land. If it's combined, assume it's the land. And one other item, hold on, I guess it's on the next slide. Okay, so basically this is what I've said. It's the building, it goes to the building, not the land. And develops land, it includes any capitalized as part of the acquisition cost of the developed land. So the only time interest is capitalized on land is if you, in essence, build the land. So in other words, we're developing plots of land for resale. And the last thing that kind of goes under these special topics is if you borrow money and you invest it and you earn interest income on those investments, don't offset the interest income against the interest cost. So before, in our fixed assets way back here, where I had a refund of a premium, I netted the two against it. Here, when I had salvage on the raised, I netted those. But with interest, I don't net them. Okay, so I think we're going to stop here and record it in a different one.